Hi, my name is Sanchita Mukherji. I'm a leading senior private wealth manager here in India. I've been a career private banker for the last 2 decades. I'm here with Kaiwaa Productions and I shall be talking about the various avenues of wealth management and where all one can invest in today's date. So when we talk about investment, I just would like to say that there are many opportunities, many avenues in today's date. The whole idea would be to beat inflation in India and to make a decent kind of return for yourself, keeping in mind your circumstances, keeping in mind your surplus, keeping in mind your risk return appetite and your time horizon and objective for these investments. So different people would have different kinds of objectives. Say somebody would like to have an investment portfolio which is geared towards retirement, whereas somebody else would like to have an investment portfolio for the education of their children. These could be of various objectives, but what I would like to stress upon is you need to understand your liquidity situation, your tax situation, and then go ahead with investments. Now when we talk about investments, there are a lot of investments available in India. For example, the very basic ones which are savings banks and fixed deposits. Then you have life insurance products, you have medical insurance, you have mutual funds. Within mutual funds, there are plethora of products like debt mutual funds, equity mutual funds, and for ultra HNIs, of course, you have very, very specialized exotic products which are private equity, venture capital, you have PMSs, AIF, and all of these structures. So I will not get into the more complicated and exotic structures at this point in time, probably at a later show, but right now I would talk about the very, very basic structure of investments and how one can proceed if you were an absolute fresher who's just started working, you're a millennial who's just started working, you're a young professional who's generating the kind of surplus or capital every month. So you should be looking at some basic structure and how to go about with investments. So when we come down to tax planning, one should look at definitely life insurance. My experience in life insurance is stay away from high cost products completely. They do not work. Very few endowment ULIP products really work in today's date. I'll tell you my philosophy in insurance. Insurance is a product that is meant to cover only your risk. Right? So if you feel that there is a risk on my life and I want to cover my life, go for a plain term insurance. There are plethora of term insurance. Just go to a good website. You can go online, sign up, put in all your details, fill up the form, go for a medical and insure your life for your family with a good, simple, plain vanilla term policy. Most of these term policies, by the way, are designed very well in today's date. They cover critical illnesses, they have riders, so you are protected. Similarly, if you have taken a house, you can have an insurance on your property, you can have an insurance, a medical insurance, which is a must, I feel, for all of us, for your entire family. Ensure that your entire family, including your children, your parents, are all included in the medical health insurance, such that you're not really shocked if you're going into a hospital suddenly and you see a large 5-figure bill appearing, you're not out of depth. So definitely medical insurance is also something that you can file for, and these are all products that are easily available online. You can even check on their premiums and all of that. The good thing is on life insurance, medical insurance, you get very good tax rebates. So definitely do look at that aspect along with your chartered accountant, because once you get these exemptions, then your taxable income comes down. So it is a good thing. You should definitely start off having a good term policy, getting your life insured, getting the health of yourself and your family insured, and then proceed forwards. After that, let's assume you're not staying on housing rent, you're planning to buy a property. So the housing loan can also be offsetted from your taxable income. So that is also a good thing. Once we have addressed your risk, covering the risk, once we've addressed your living conditions, going for a housing loan, all of that, keeping in mind your children's education, all other expenses, running a family, when you do generate a surplus above and beyond all of that is when you should start looking at designing and making a financial portfolio. Now, why would I advocate a financial portfolio? Traditionally, if you were to see, our fathers, grandfathers would have all invested in real estate, gold, right? So these real estate, gold is typically known as real assets. So why real assets versus financial assets? I will tell you why. Financial assets give you adequate liquidity at the click of a button. Moreover, they are very, very tax efficient, right? Real estates comes with its own issues. They are not tax efficient. There are plethora of taxes involved. There's a problem in maintaining a property. There's a problem of liquidity. There's a problem of storing gold. And the biggest problem is whether or not you land up making any capital gains at all or not. Let's understand, India is a growth economy, right? Real estate as an asset typically becomes a large asset bubble when a lot of corruption-ridden money goes into it, and after that it can significantly have a bear run for the next 7 years, and one can actually lose out on the opportunity cost that one can make even from a basic fixed deposit, rather than investing in real estate and not making any money, rather losing money in the next 5 years, right? So now let's assume you do not go for real assets like real estate or gold, and you look at a financial portfolio. Please understand, when you're designing a financial portfolio, again, what is very important is you need to keep the time horizon in mind. You need to keep your objective in mind. You need to keep your liquidity requirement in mind, also whether you need to generate income from the portfolio or not, and you need to keep your risk in mind. Typically, if you're a young person who is going to be working for the next 20-30 odd years, you need to understand something which is known as asset allocation. That is, what percentage of your portfolio should be in a fixed income product and what percentage of your portfolio should be in an equity or an equity linked product. Once you have this asset allocation clear to your head, you have to be very, very prudent in sticking to your asset allocation, because over a longer period of time, those asset allocations will absolutely generate the kind of returns that you have in mind for yourself. So when we are designing a financial portfolio and we are sorted in terms of what is our risk appetite, whether I should be 30% in equity or 20% in equity or 40% in debt, 50% in debt, that is when you start designing the portfolio. When you design a portfolio, you need to understand what are mutual funds, what are the different types of debt mutual funds, what are the different types of equity mutual funds. So within debt, you have liquid funds, you have accrual funds, you have dynamic bond funds, you have income funds. Now each of these funds comes with their own objectives and own timelines, own exit loads and all of that. Similarly, within equity, you have plethora of funds. You have sectoral funds, you have a mid-cap fund, you have a small-cap fund, you have multi-cap funds, you have balanced funds, and between equity and debt, you have something known as hybrid funds, which give you a much smoother ride with lesser volatility but slightly higher than fixed income returns. So this is something that is very, very required, this kind of understanding when you're designing your financial portfolio. But we must understand that the trick to investing is actually starting very early, because what I've understood in India is a lot of people ignore the power of compounding. The power of compounding is the single most criteria which will actually help you create wealth for yourself. The sooner you start saving and investing, the compounding effect starts having a multiplier effect. So I would suggest just go out, start your own financial portfolio, understand these products, design your portfolio and have a good time investing. Thank you.